Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Okay, let's just get right into it. Darkiris Inc. Ticker is DKI. As of this morning, February 2nd, 2026, we're looking at a stock that has been absolutely decimated. It's trading in a really distressed range, somewhere between 30 and 40 cents a share. The market cap is hovering right around that $7 million mark, give or take a few hundred thousand depending on the hour. The volume is, well, it's sporadic. Barely a pulse on some days, and the chart is just ugly. We are talking about a stock down over 90% from its 52-week high of $15. 15, which it hit right after its IPO in August of 2025.
It's a crime scene. I mean, there's really no other way to put it. When you see a 90% drawdown in, 6 months, you aren't looking at a correction. That's a collapse. Pure capital destruction.
It is severe. I won't sugarcoat it. But that devastation is exactly why we're talking about it. The central question isn't, did it crash? We know it crashed. The question is this. Is Darkiris a broken, nanocap on the verge of delisting, destined for the graveyard of the ODC markets? Or is this a debt-free company, growing revenue at 27%, that the market has irrationally punished because of some ugly headline accounting? I'm arguing for the latter. I think the baby has been completely thrown out with the bathwater here.
And I think the bathwater is toxic. See, you see a bargain, I see a classic value trap. My position is that cheap does not mean valuable. Just because a stock is down 90% doesn't mean it can't go down another 90%. Darkiris is facing an existential delisting crisis. Its margins are being absolutely crushed by platform fees, and frankly, the corporate governance is a minefield. This isn't an investment. It's a gamble on a company that's just burning its own equity to stay alive.
Okay, I get why you say that if you only look at the net loss. So let's tackle that head on. You look at fiscal year 2025, you see a net loss of $8.64 million. For a company with a $7 million market cap, that looks like a death sentence. But you have to peel back the onion. That loss is almost entirely an accounting artifact. It includes $8.81 million in non-cash stock-based compensation.
You call it an artifact, but stock-based compensation is real dilution. It's printing new shares to pay people because you don't want to use cash. It dilutes the existing shareholders. It's a very real cost to the equity holder.
It is dilution, sure, but it is not a cash burn. And that is the critical distinction for survival. If you exclude that one-time charge which is related to the IPO incentives, the company actually generated a modest operating profit of roughly $170,000. This isn't a company bleeding cash from its operations. They're basically cash flow positive on an adjusted basis. And while this is happening, revenue grew 27.3% year over year to over $10 million. And critically, they have zero debt. Zero. Their cash position actually improved to $1.8 million as of September.
You can adjust the numbers until they look pretty, but you can't adjust the trajectory of the business model itself. You're celebrating the revenue growth, but I'm looking at the gross margin compression. This is the really scary part. In 2024, their gross margins were 38%. In 2025, they collapsed to 24.8%. I mean, that is a massive deterioration in the core economics of the business.
I think it's a transition period.
It's a structural problem. Why did the margins crash? It's because the cost of doing business on the Apple App Store and Google Play Store, the platform handling fees, they skyrocketed by 76% to over $6 million. Just think about that math. Revenue grew 27%, but the fees they pay to the platforms grew 76%.
Because they're scaling user acquisition. It's a cost of growth.
But the costs are outpacing the growth. That is what I call the platform tax. They are running on a treadmill that is just speeding up. They are paying Apple and Google more and more and more just to keep that revenue line moving up. If that trend continues, there's no profit margin left. It goes to zero.
I think you're extrapolating a single year of aggressive marketing spend into infinity. But look, before we get into the long-term margin story, we have to address the elephant in the room.
the immediate price action, and the NASDAQ deficiency.
The minimum bid price deficiency?
Correct. They got the notice in November of 25 because the stock has been under $1 for 30 consecutive days. They have until May 2026 to fix it.
Which is a ticking clock. If they don't fix it, they get delisted. They get booted to the pink sheets, and that's where liquidity goes to die.
Which is why they have the annual general meeting coming up. They're going to propose a share consolidation.
A reverse stock split. Yeah, let's use the common term so everyone understands the mechanics here.
A reverse split, yes.
And for anyone listening who hasn't been through one of these meat grinders, a reverse split is when a company combines its shares to artificially boost the price. So if you have 10 shares at 30 cents, they might turn it into one share at $3. The value of your holding doesn't change, just the share count. But historically, the market hates this. It's a huge signal of weakness.
It is a tool for compliance. It's standard operating procedure for companies in this exact situation. It keeps them on the NASDAQ. That is the priority. Retaining that NASDAQ listing is crucial for liquidity. So, if they execute the split, get the price back above the minimum bid, they remove the regulatory overhang. Right now, the market is pricing them as if they're already delisted. If they survive that hurdle, and I believe they will, because insiders own half the company and they need this to work, then the market cap is just absurdly low compared to its peers.
If they survive. That is the key phrase. And you mentioned peers. Let's talk about that. You think this is undervalued?
Oh, absolutely. Look at the valuation disconnect. Dark Oris's trades at a price-to-sales ratio of roughly, 0.56 to 0.7? You're buying $1 of revenue for 60 cents.
Because that dollar revenue costs them $1.10 to generate.
But compare that to a giant like Take-Two Interactive. They trade at 7, 8, sometimes 10 times sales.
Okay, come on. Take-Two has Grand Theft Auto. Dark Galers has a handful of mobile card games. You cannot compare a battleship to a canoe.
Okay. Forget Take-Two. Look at other microcap gaming studios or software companies. Even the distressed ones usually trade at 1 or 2 times sales if they have growth. Dark Galers grew revenue 27%. This is not a dying business shrinking 20% a year. It is growing. A sub-1 price-to-sales ratio for a double-digit grower with a clean balance sheet it's just rare. The market is pricing DKI for bankruptcy. And if they're not going bankrupt, and the $1.8 million in cash says they are not, then the repricing upwards could be violent.
Violent is one word for it. Let's talk about the business itself. You keep mentioning this growth, but we need to look at how they make money. They're a mobile game developer and publisher. Historically, they just published other people's games, licensed third-party stuff.
Which still accounts for about 55% of their revenue right now.
Right, and it's low-margin stuff. But the risk here is the concentration. They are 99% dependent on third-party platforms. They live and die by the algorithms of Apple and Google. And worse, there's massive product concentration. Their top 3 games account for 64% of their total gross revenue. If one of those games gets banned or just falls out of favor, and we all know how fickle mobile gamers are, the company could just collapse.
I think you're characterizing dependency as a weakness when it's simply the industry standard. I mean, unless you're big enough to build your own app store, you pay the rent to Apple. But look at the shift in their revenue mix. This is the core of the bull thesis. They are moving from those low-margin licensed games to high-margin self-developed games.
Is that shift actually working, though?
The numbers say yes. Revenue from their self-developed titles grew 84.7% to over $4.1 million. They're transitioning from being a middleman to being an IP owner. When you own the IP, you control your destiny. That 84% growth in self-developed content, that validates the entire strategy. The new titles like Alchemy and Magic, and the ones slated for 2026, that's the future.
But Alchemy and Magic has to compete with thousands of other games released every single day. And that brings me to the governance. Because if I am going to bet on a turnaround, I need to trust the jockey. We need to talk about the CEO, Zhifeng Hong.
Zhifeng Hong has been the CEO since 2017. He built this company. He took it from a local Hong Kong studio to a NASDAQ listing. He is not some corporate suit brought in to strip the assets. He's the founder.
And he acts like one. This is a classic controlled company. Hong owns about 34% of the equity, which is a significant chunk, I'll give you that. But thanks to the dual-class share structure, He controls roughly 90% of the voting power.
Which allows him to execute a long-term vision without being harassed by short-term activists.
Of course, it allows him to drive the bus off a cliff without anyone being able to grab the wheel. Minority shareholders, the people listening to us right now, have zero say. Zero. If Jifeng Hong decides to pivot the company into crypto mining or toaster manufacturing tomorrow, nobody can stop him.
But why would he do that? His interests are aligned with ours. Insiders own roughly 50% of the company total. If the stock goes to zero, Hong loses his fortune. He is massively incentivized to save the stock.
Let's talk about that incentive. You say insiders own 50%. But let's look at recent activity. The stock has crashed from $15 to 30 cents. It is on a fire sale. Have we seen any insider buying in the last 3 months?
There hasn't been reported buying in the open market now.
Exactly. Silence. If the CEO thought this was a steal at 35 cents, why isn't he buying? If the CFO thought these accounting artifacts were hiding a gold mine, why aren't they backing up the truck? Management is in wait-and-see mode. And if they're waiting, why should a retail investor jump in?
Well, they might be restricted. We have the AGM coming up. We have the compliance plan. They likely possess material non-public information regarding the reverse split mechanics or partnership deals. They can't just buy whenever they want. They have blackout periods. Absence of evidence isn't evidence of absence.
It's not bullish, though. And you know what else isn't bullish? The institutional ownership.
Here we go.
It is virtually non-existent. We're talking 0.27% to maybe 0.5%. There is no BlackRock. There is no Vanguard, no Renaissance Technologies. The only institutions here are tiny firms like Scientech or Centtiva holding a few shares. When the smart money, the people with teams of analysts and algorithms, stays away completely, that is a massive red flag.
It's a nano cap. It's a $7 million company. BlackRock doesn't get out of bed for $7 million. If they put a standard position size on this, they would own the company 5 times over. They have liquidity mandates. They can't own more than 5 or 10% without triggering all these reporting requirements. They simply cannot play in the sandbox. That lack of institutional coverage is exactly why the opportunity exists for retail. The market is inefficient here because no Goldman Sachs analyst is covering it. You are on your own, which means you can beat the market if you're right.
Or you can get crushed because the market is efficient and has correctly identified that a company with falling margins and a dictator CEO is in fact uninvestable.
Okay, let's make this practical. We have listeners who look for these asymmetric bets. Let's run the numbers on a hypothetical investment. Say someone puts $5,000 into Dark Harris today at, say, 35 cents. That gets you roughly 14,285 shares. Walk me through the next 6 months.
I'll give you the nightmare scenario first, the value trap outcome.
Go ahead. So, over the next 6 months, the AGM happens. They approve the reverse split. Let's say it's a 1 for 10. Your 14,000 shares become about 1,400 shares. The price theoretically adjusts to $3.50, but the market smells blood. Short sellers pile in because the float is still small and the fundamentals haven't actually changed. The platform fees keep eating the margins. The stock drifts down from that post-split price of $3.50 back down to $1.50. Or worse, they fail to regain compliance and get booted to the OTC. In that scenario, your liquidity just evaporates. The stock trades at the equivalent of 15 cents pre-split. Your $5,000 investment shrinks to about $2,100. You lose 60% of your capital in a blink.
That is the risk, I acknowledge that. But let me give you the deep value scenario, the bull case.
Let's hear it.
Same setup. $5,000 investment. The reverse split goes through, keeps them on the NASDAQ. That's step 1. Step 2. The Q1 numbers come out and Alchemy and Magic shows real traction. The high-margin, self-developed revenue starts to overtake the platform fees. The market realizes the bankruptcy risk is off the table. The stock creates a technical rebound. If it returns to a pre-split equivalent of just $1, which, mind you, is still 93% below its IPO highs, your investment triples. That $5,000 jumps to roughly $14,200.
You're banking on a 3x return just on a survival bounce?
Yes, that's how distressed investing works. When you price something for death and it doesn't die, the repricing is explosive. And if we look mid to long term, say 18 months out,
Assuming they're still here.
If they stabilize margins, negotiate better fee structures, or scale volume enough to offset them, and get a re-rating to a price to sales of just 1.5. That is still cheap for software. That puts the market cap at roughly $18 million. That $5,000 investment is now worth $15,000.
And the blue sky?
3 to 5 years. If Jifeng Hong's strategy of transformative growth actually works, and they successfully diversify into those AI interactive experiences they hinted at in the reports, this could be a $50 million market cap. That's a 7x return. The potential value of that initial stake could be $35,000 to $50,000.
You're projecting a 7x return on a company that hasn't proven it can turn a GAAP net profit. And look, long-term holds here are dangerous for another reason we haven't touched on enough: geopolitics.
They're based in Hong Kong.
Exactly. Legally headquartered in the Cayman Islands, sure, but the operations, the team, the heart of the beast is Hong Kong. The regulatory environment there regarding data and tech is not what it was 10 years ago. It's unpredictable.
They did dispose of their mainland China subsidiary, Turing. They're trying to insulate themselves. They are pivoting to Southeast Asia, Taiwan, global markets.
But the risk remains. If regulators in Hong Kong tighten the screws on gaming, which China has done repeatedly, Darkeris is caught in the crossfire.
True. But again, the valuation buffer is massive. When you buy something for 35 cents that has $1.8 million in the bank and no debt, you have a margin of safety. You're buying the cash and the IP for pennies.
A margin of safety implies the asset has intrinsic value that won't erode. My fear is that the asset here, the game portfolio, is decaying faster than they can build new ones. That $2.9 million decrease in revenue from their older titles proves it. They're leaking revenue from the bucket while trying to pour new water in with alchemy and magic.
That's the nature of the gaming industry. It's a hit-driven business. You have a portfolio. Some die off, new ones launch. But unlike so many nanocaps that are purely hope stocks, with no revenue, biotechs with no drug, miners with no gold, Darkerist has $10 million in sales coming in the door. That is real traction.
Okay, so let's summarize the risk profile for the listener who is eyeing that $5,000 trade.
It is high risk, no doubt.
It's extreme risk. You have execution risk. Can they actually make hit games? You have platform risk. Will Apple raise its fees again? You have regulatory risk, the NASDAQ delisting. You have governance risk, the controlled company structure. And you have geopolitical risk.
And you have zero debt risk. That's the counterbalance. They don't owe money to the bank. They don't have interest payments choking them. They have cash.
Cash burns pretty fast when you're losing money on every user you acquire.
But they are investing that cash. It's not being wasted on private jets. It's going into R&D and marketing.
We hope. With a lack of transparency in a controlled company, we're basically taking their word for it.
So, final verdict. How do you see this playing out?
My final word is caution. Extreme caution. The lack of smart money involvement is the loudest signal here. When you combine that with the structural cost disadvantages of the platform tax and the governance issues, I simply cannot recommend this as a long-term hold. It's a falling knife. If you want to gamble on the bounce, fine, but know that the house, in this case, the NASDAQ rules and the platform fees, has the edge.
And my final word is opportunity. Dark Iris is a real business with $10 million in revenue trading for the price of a shell company. The $8.6 million loss is a paper tiger. The cash is real. The debt is zero. If you trust Jifeng Hong to navigate the NASDAQ compliance maze, and his 50% ownership suggests he will try very, very hard to save his own fortune, the upside here is significant. It is an asymmetric bet. You can lose 1 times your money, or you can make 7 times.
The deciding factors are coming up fast.
Absolutely. The timeline is tight. We both agree that the upcoming annual general meeting regarding the share consolidation is the very first hurdle.
And the Q1 2026 performance. We have to see if the revenue from the new games actually drops to the bottom line, or if it just gets eaten by Apple and Google. If those margins don't stabilize, the bull case completely collapses.
Correct. So the listener has to decide if they trust the CEO and the balance sheet, or if they fear the delisting and the margin compression.
It is a fascinating, if terrifying, case study in microcap investing.
That it is.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.